and welcome to our webinar. We're going to get started now and talk about how to structure contracts for real estate deed investments. We have a guest today, Amir Khan. He's going to join us in just a moment. My name is Larissa Greene. I'm with Advanta IRA and I'll be hosting today. We will be taking questions at the end of the webinar. Amir is going to go through all of the information he is providing. He also has a frequently asked questions section, so he wants to make sure to get through that, and then we'll take questions at the end. There is a question box in your navigation, so just type any questions you might have as we go into that navigation box, and we'll get them answered at the end. We also uploaded the slides as a handout for you, so again, if you check out the webinar navigation, you're going to see a handout section and it's uploaded as a PDF, so you can download that for review later. Again, my name is Larissa Greene. I'm with Advanta IRA and I've been with Advanta since 2011. Right now I'm doing Director of Education and Business Development with Advanta, but I actually started doing things like opening accounts, transactions, transfers. I coded checks for receipt for income on investments. So I've done a little bit of everything over my time here, but I've been doing business development and education for about 11 years now. My contact information is here, and I also have a QR code that will take you to more information about me and how to get started. If you have any questions about an IRA, please feel free to give me a call or send me an email. I'm happy to answer any questions, and especially keeping in mind that we do have education going on always. And so if you have more questions about an IRA or more specific questions about an investment structure, please feel free to send me an email and let me know, and we can either schedule a call, or I probably also have webinars on those topics for you. Please keep in mind that Advanta IRA and its employees do not provide investment advice or endorse any products. All information, including today's webinar, is for educational purposes only. Please make sure to consult your attorney, accountant, or financial advisor before making any investment, and making sure to do your own due diligence. Advanta IRA has been in business over 20 years. We have over $3 billion in assets under administration. We have 2 offices. We're in the Tampa Bay area of Florida, very specifically in Clearwater, and then we also have an office in Atlanta, Georgia, but we can help anybody anywhere. We actually have clients nationwide and even worldwide. So if you have an US-based retirement account, an old employer plan that is US-based, you can self-direct those accounts and we can help you with that. Every person with Advanta receives a dedicated account manager for the life of the account, so that they have dedicated personalized service with their self-directed IRA. And I think that really makes us stand out among our peers, and really helps you to build a relationship with the person you're going to be working with. And that way they understand the investments that you like to make and what to expect. And then that also helps you know who to reach out to when you have a question about your account, whether it's for contributions or investments that you might be making. I'm going to introduce Amir in just a minute, but I wanted to give you a brief overview in case you're new to the idea of a self-directed IRA. When we talk about self-directed IRAs, we're actually talking very specifically about the types of investments, not the types of accounts. And I think that people get a little confused on that, because when they come to us and open an account, they say, well, I want the self-directed one. Which one is that? We can hold anything that would be considered a qualified plan. So IRAs, whether they're traditional, Roth, SEP, simple, but we can also help you with solo 401ks, education savings accounts, and health savings accounts. And all of those accounts are self-directed with us. We don't do anything market-based at all. When we talk about self-direction, we actually are talking to or referring to the type of investment that you're making. And those investments with us are all going to be considered outside of the market, private investments. Whether you're buying real estate, lending money, investing in a fund, all of those are going to be outside of the market. And there's no definitive list provided by the IRS that tells us exactly what we can invest in. Instead, what they've done is told us what we can't invest in. And we do have webinars on those topics, but we like to kind of provide a short list of investments that we see pretty frequently at Advanta to give you an idea of what others are investing in. And that could be real estate, whether you're buying real estate for the purpose of buy and hold, fix and flip. It could be single family homes. It could be multifamily for syndications, commercial property. You can invest in private mortgages and notes. We see people invest into private funds for things like startup businesses, precious metals, cryptocurrencies, syndications, and the list truly does go on and on. I mean, it can include things like film projects, movies. It could include racehorses, cattle, alpaca. And so we really do see a lot of people putting on their entrepreneurial hat and making investments into what they know best and what they choose. If you haven't heard of a self-directed IRA, it's just very simply because there's not a lot of companies out there like Advanta willing to hold private investments. They're not sure how to title those assets, how to do their record keeping or receive income, or even pay expenses. If you think about that, your brokerage firm does not pay expenses on behalf of your IRA. Whereas at Advanta IRA, that's something we do all the time, whether it's for fix and flip real estate or buy and hold real estate, things like property taxes and insurance. It could even be paying vendors like plumbers and roofers. And so that's something that we have chosen to do, and we are very successful at it. Only about 4% of all retirement accounts are truly self-directed, and another reason that you maybe haven't heard of companies like Advanta. So now I'd like to introduce you to Amir, and he's going to talk to us about this different structure. And I don't think we've had somebody talk on this structure of using land contracts and agreements for deeds. So we're going to have Amir explain to us how that works. Hi, Amir, how are you today?
I'm great. Thank you, Larissa. Well, first, I'd like to thank Advanta IRA for inviting me as a guest speaker in today's webinar. Hello, everyone. My name is Amir Khan. I am the managing partner at Dream Prime Homes. And today we are going to discuss how we structure our deals. And we're going to learn about how we use land contracts to structure our deals. So today we're going to talk about how to build private lending portfolio and earn predictable income. And we're going to learn that by structuring, by using real estate land contracts. So I do have to read this disclaimer. Real estate investments are not guaranteed, and any past performance is not a guarantee of future performance. There are risks associated with any investment. Please carefully consider all aspects of any opportunity before investing. We are not a licensed financial investment advisor, lawyer, and/or tax professional. Please consult with your CPA and/or financial tax advisors before making any investment decisions. The material in this guide should be used for general guidance and informational purposes only. All right, so this is the outline for today. I'm going to give you a brief overview about our company and about myself. We'll then dig right into talking about land contracts. Then we're going to talk about private lending, because that's how we bring investors to invest in these deals with us using land contracts. Then we're going to specifically talk about our real estate investment strategies where we are using land contracts. Then we have a very detailed frequently asked questions section, so I'll go through those. And at the end, we'll explain how, if you're interested, you can contact us. So having said that, let me start by just a brief overview about myself. I've been in real estate since early 2000s. And so I have over 20 years of experience as a landlord on the residential real estate side. I've been a property manager, managing my own portfolio and managing my manager. And I have over 20 years of experience as a wholesaler on the residential side. I have over 5 years of experience as a flipper, buying and fixing and selling properties. I own and operate a commercial real estate investment company as well. I am the owner operator of Dream Prime Homes. Our portfolio currently is in Texas, Ohio, and Illinois. On the business side, I have been a business owner since 2009. I also own a successful music school here in Dallas that maintains a staff of 10 and a roster of over 150 students. And if you'd like to learn more about me, this is my LinkedIn profile. All right, so this is a very brief synopsis of how we are structuring our deals, but I will obviously go into more details. We are a Dream Prime Homes LLC based in Dallas, Texas. Our current portfolio is in Texas, Ohio, and Illinois. We have about $1 million under management. The properties in our portfolio include smaller properties like 2-bedroom, 1-bath, to larger 3-bedroom homes. So the square footage varies from as small as 700 square feet to up to 3,000 square feet. The end buyer in our transaction is called a tenant buyer, and these include homeowners, tradesmen, and or investors. All tenant buyers are required to make payments through our online mortgage payment system, which means that takes out the hassle of taking cash or check and stuff like that. We don't do that. Same with our private lenders. Our private lenders receive their monthly principal and interest automatically via ACH. So it's an automated process. So our private lenders are passively earning income and are growing their portfolio and enjoying their stream of monthly income. All right, so digging right into land contracts, and I have them by sections, so it's a little bit easy to understand. So number one, what is a land contract? The term varies. So in some states, they use a different term for it. They also call it a installment contract. It is also called agreement for deed or contract for deed, but they all mean the same thing. This is an agreement between the buyer and seller under which the buyer agrees to pay the seller the purchase price plus the interest in installments over a set period of time, right? The seller retains the deed. That's the main key here. So that's that's the amazing thing about this. The seller retains the deed till the entire installment mortgage is paid off. However, the buyer can sell the property, and if sold for more than what the buyer bought it for, the buyer keeps the difference. So that's their equity interest in the transaction. Two, how is it different from simply buying and selling a piece of property? Well, this type of contract is used when you're offering a property for sale with owner financing. This way, the seller continues to hold the deed and control. Three, what are the benefits to structuring it this way? The biggest benefit for the seller is that you can evict your tenant buyer versus foreclosing on the buyer. So that means that also the seller is no longer responsible for property maintenance, property tax, and insurance. The monthly payments that we receive from our tenant buyers include taxes and insurance. Four, how is the land contract secured? For the seller will secure it with a down payment from the tenant buyer that is applied towards the total purchase price, and the buyer secures it by filing the land contract with the local county. Five, what is a tenant buyer? So again, the tenant buyer is the person who is the buyer in the land contract. He or she is no longer a renter and is a homeowner and therefore is responsible for property maintenance and upkeep. Six, does the public record show the holder of the contract or the tenant buyer as owner? And when we are doing the transaction, the public record will show Dream Prime Homes LLC as the entity holding the deed. The tenant buyer is responsible for filing their land contract with the county. Seven, how does the tenant buyer take title and when? The tenant buyer takes title once their 30-year mortgage is fully paid off. Eight, how is land contract held versus a mortgage or deed of trust? So basically, these are three different instruments. So a land contract is a seller financing agreement between buyer and seller to purchase a property on installment payments, right? Whereas a mortgage is a document created for lender protection, and that has a lien on the property being financed. Whereas deed of trust is the title that certifies the ownership of a property. So there are three different instruments. Nine, what happens if the tenant buyer doesn't make their payments? Well, that is the beauty of land contracts, is that they can be evicted for non-payment using a non-judicial foreclosure process, which is typically way shorter than a foreclosure process. Okay, now I'm going to go into a little bit more details about our specific real estate investment strategy. So in our real estate investment strategy, we employ it. Our investors are private lenders. So our investors are not directly investing as an owner in the property. And so they are a private lender. And here are the top 5 benefits of being a private lender. Number one, I think we skipped, yeah, let's go back here. Here we go. Number one, passive income stream. Private money lending provides a consistent and predictable return of investment without the need for active management. Number two, there is no property insurance, property ownership responsibilities. So the investors do not have to deal with the responsibilities of property ownership, such as maintenance, repairs, or tenant issues. Number three, high returns of investments. Private money lending can offer higher returns compared to traditional investment vehicles like stocks and bonds, and often are in double digits. Number four, collateral security. Loans are typically secured by the property itself, reducing the risk of loss. So in case of a default, the lender can foreclose on the property. And number five, flexibility and control. Investors have the flexibility to choose the deal they want to fund according to their preferences and risk tolerance. So now let's talk about private lending. If you ever Google, how do banks make their money, or what do they do with the money, right? When you make a deposit in a bank, this is literally the answer you're going to get. Banks use the money in deposit accounts to make loans to other businesses and people. In return, the bank receives interest payments on those loans from borrowers. And which banks do this? All of them, right? Wells Fargo, Capital One, Citibank, Bank of America, you name it. Well, how about insurance companies? If you were to Google, what do insurance companies do with their premiums? And your answer would be most insurance companies generate revenues in two ways: charging premiums in exchange for insurance coverage, and then reinvesting the premiums into other interest generating assets. And which insurance companies do that? All of them. The Hartford, AIG, Farmers, you name it, right? All right, so my question to you is, would you like to be in the same business as them? And so now I like to show you visually how our system works. All right. So in our system, in our strategy, you become the lending institution. So you are the lender. You're funding a real estate transaction. And here is the key thing. There is only one lender to one property. We do not commingle funds. There is no group of investors investing in one property. So there's always one lender to one property. So in return, you are, as the investor, as a private lender, you're protected, secured, and insured, and you are getting monthly principal and interest payment. In this transaction, we are the borrower and we hold the deed. Now I'm going to go and show you the other side of the equation, which is, so I already explained this side, right? Which is you're the lender and we are funding the transaction, and we are the borrower, right? Now, this is the other side of the equation, which I just explained about land contracts. So then we are going out and we are taking the same property. This is the key. We are not making any upgrades or repairs at all. So that's why I'll go into the second section of the presentation where we talk about the condition of the property. And we are simply taking the same property and we have on the ground team that we start marketing, depending on the type of property it is, that it will match a end user who's going to make it a home. It could be a contractor or it could be a wannabe landlord, right? And so it is sold on a land contract to them. The deed stays in our name and only transfers over to them when they pay off their mortgage. All right. And I'm going to talk about more on this side of the equation. On this side of the equation, the note that we are creating with our private lenders is a 5-year note, whereas the land contract that we are creating is a 30-year mortgage. All right. So now let's go in. And now we are talking about specifics of our strategy. Number one, what kind of assets are we buying? We are primarily buying single family homes that are 2-bedroom, 1-bath or larger. 2, most homes need work. So these are not retail ready homes. They are either habitable right off the top or they're very close to being habitable, need minor work. Number 3, we buy in areas where the average rent will support our financial models. Next, where are we buying these homes? So homes are always bought in states that are landlord friendly. So obviously we're not buying in New York, we are not buying in California. We are currently buying assets in the Midwest. And here is an example of some of the pockets that we are buying in right now. St. Louis, Missouri, which is a very big market. Alton, Illinois, Cahokia, Illinois, East St. Louis, Illinois, Toledo, Illinois, Muncie, Indiana, and there's a whole bunch of other markets like these.
Amir, sorry to interrupt. I did have a question on the strategy that you use where you have a private money lender. So let's say investors out there want to employ this system for themselves. Many people that know about self-directed IRAs more use them as a tool in their tool belt when they're maybe not raising capital, but of course, raising capital, but also in, single deals. And so if they are looking at something like this, in both scenarios, if they're, borrowing from someone to then purchase the property to then sell it on a land contract, in all of these legal documents, can they stipulate who is responsible for what? Meaning, I think you mentioned that the tenant is giving you or paying you so that you're covering, the insurance and real estate taxes. Is that pretty typical in a land contract, or are you stipulating that in your land contract that you're covering it? And can you say, oh, and the tenant buyer could be responsible for that and not
Yes,
included in the payment?
that is an excellent question. And yes, we do stipulate that. And one of the reason is because of the usury law on the interest that we can charge in different states. So if, and I'm just throwing out numbers there, if the property is sold at, I don't know, 60 grand, and the amount of payment that we are getting is not comparable to what the market rent is, then what we do is we figure out what part of that payment would be, what is the maximum we can charge as the actual structured mortgage, right? And then we
Mhm.
figure out the interest, then we figure out the insurance payment and taxes, and where would that bring in the amount. So to answer your question, yes, it is stipulated clearly that their payment includes taxes and insurance. And over a period of time, we've learned that if we leave it to the tenant buyer to pay the property taxes, well, sure enough, they don't. Right? So if
Right. So,
we hold the deed, then we end up getting the bill and find out surprisingly after years that they've never paid their property taxes. So that's
mhm,
why we pay the
gotcha.
property taxes, and that's why we pay the insurance.
Okay, so that's good information. So if you're looking at this kind of structure, Amir's experience kind of tells you, why they structure deals in a certain way. And so also a couple of months ago, we did a webinar talking about raising capital, whether it was for single deals or for funds or whatever. And so when you're looking at deals like this, employing your own strategy, but using the information that you are learning here is very important because you have someone that has the experience, and Amir just shared why they structure it that way. And I have seen deals where people say, hey, this is why I structure it this way in this state. So I think that's important too, because Amir mentions which states they work in and why. So just be aware of what the landlord tenant laws are in your states, and also what usury is, because that's going to be very important too. Thank you, Amir.
Thank you. Great question. Okay, so we already talked about that. All right, so now again, going into specifics, how, as a private money lender, how is your money secured and how is your investment protected? So as a private money lender, you're protected by these four key elements. Number one, there is a promissory note that we create for you, or it's created through an attorney or a title company, depends on where we are closing the property, and which spells out the terms of the loan and payment schedule. Number two, there's a mortgage created that places you as a private lender in the first lien position. Number three, there is an additional title insurance policy that we buy for our private lenders. So there are two title insurance policy. One is for us as the buyer, and then we also buy one additional for the private money lenders to protect against any title issues or claims that might arise. And finally, there is property insurance policy and that shows the private lender as additional insured. Question,
And
does, yes, go ahead.
yeah, I'm sorry, Amir. I just wanted to point out too that if you're doing a deal like this where you're structuring it and you have, questions about title policies, it is always a good idea to talk to the title agent that you're working with or closing attorney, and they can always give you, especially if you're working in states that you haven't worked in before. I know I do private money lending, and whenever I'm working on something, I always make sure to ask those questions. So, Amir pointed out the different types of policies, and I think that's very important. Again, making sure you're doing your own due diligence, and I think that's part of your due diligence. Thanks, Amir.
Yep, sure, absolutely. And my my experience is quite interesting. Title insurance, title companies are all sorts of title companies. Some of them are extremely professional. They are extremely good. They're on top of things. And then I've had some really bad experiences. So what we try to do from our side, we ensure that when we are in a contract, we are the one making sure that the whole transaction goes according to plan. So I'm just going to throw it out there, since we're talking about title insurance and title companies, is that the funds never come to us. Whenever our private lenders work with us, the funds are always wired directly to the escrow officer or the title company. So that's why when we are in the transaction, we want to make sure we ensure that everybody who is involved in the transaction is aware on how it's going to close, especially when there is a self-directed IRA involved. Because in my experience, I've seen someone who has a checkbook control, it's rather easy. It's wired the same day, and we have a credit the same day. But when there is no, and correct me if I'm wrong on this, Larissa, if it's not a checkbook control, then the docs have to go from us. The mortgage has to be notarized from us. Then it has to go directly to the custodian company, where it's going to be notarized by them, and then it has to go to the title company.
That's correct. The custodian is going to be the legal signer for the IRA. And so if you're using an LLC or a trust, as Amir mentioned, for checkbook control, you certainly can do that. And of course, it has its own pros and cons. But when the IRA is holding funds directly to make that investment, then Advanta IRA would sign on behalf of the IRA for the investment.
Correct. Okay, cool. All right, and question, does the investment terms and returns vary per deal? So to make it easy to work with us, the terms are standard and do not change. And those are something we can go over once we have a one-on-one consultation. Okay, do I get to choose the property I invest in? So absolutely. As we have properties under contract, we have a portal on our website. When you're accepted as a private money lender in our system, you can log in and you can see all the properties that are currently under contract. You can review. We actually have a very detailed property profile that we create for each property that comes under contract. It has specs on tax record, it has mortgage information, it has sold comps, it has rental comps, and then we do our underwriting. And so you'll have a summary of our underwriting to show that. So absolutely, you can choose that. Question, what if the tenant buyer stops paying? Obviously, this is the big one. So if a tenant buyers stop paying their mortgage, we begin the eviction process. We have a team on the ground that efficiently manages the process. So once the non-paying tenant buyer is evicted, we simply repeat the process. We find another one and we place a new tenant buyer in place. So from our side, for our private money lenders, the payment will never stop. We continue to make payments, we as an operator, regardless of how many months the property is vacant or non-performing.
Now, Amir, does that process for eviction, because of the land contract, will that vary state to state? So investors using this strategy on their own, are they going to want to familiarize themselves with the eviction process because of the land contract, or is it more straightforward than that, meaning that it's an eviction in their state regardless of it being a land contract?
So that's a very good question. Yes, it does vary. So, but compared to a foreclosure process, there's a huge difference. So the maximum I had was literally 3 weeks for a eviction, but it could be more. So how we or you, if you're doing it yourself, can become really good at this is be on top of your notifications. So your contract, land contract, should specify what is the date after which the payments become late, right? So late fee is clearly mentioned that. And then it clearly mentions that after a certain date, maybe the 10th of the month, the tenant buyer becomes delinquent, and we could pursue the eviction process. And basically the verbiage, I don't know the exact verbiage, but the contract has specific verbiage saying that the contract becomes null and void, right? So once that happens, and obviously what we do is when we put these contracts in place, we make sure you run it by the attorneys in that state, so it's legal in that state. So you're absolutely right, it does vary, but the contract has to specify so that everything is in line. So when you're sending them notification because they haven't made their payments, they are very clear that if they do not catch up on their payment, they can be evicted. Because remember, they've put a down payment, so they actually have skin in the game. They're not like renters where they don't have anything to lose. They've put up a down payment, and so they have some equity in their mind.
That's a good point. And, just want to touch on something you mentioned there too, because you talked about, having an attorney in that state review it. And this is where, as an investor, you want to think about building your team of professionals. I'm not saying necessarily, keeping an attorney on your payroll or anything like that, but networking with other investors and finding out who you can turn to do things like review your contracts and legal documents is going to be very important as an investor. And if you're going to take the leap and invest out of the state that you reside in, it's always important to have boots on the ground, as we like to say, or a team that you can have do things like review contracts, help you with the legal side, also checking on your properties and things of that nature. And so that's a very, very good point. Thanks, Amir.
Sure. All right. So question, what if something happens to you, that's me, how will the payments be made? So the answer is, in this case, the property operates within an LLC and will continue to operate and pay out per promissory note by my heirs. Question, what if the property I invest in, so this is a private money lender saying if I invest in a property and it burns down. So answer is, private money lender's stake is fully protected by a property insurance policy that names the private lender as additional insured. So in case of a fire loss, our insurance policy will pay off the covered value of the loan. Question, what happens after 5 years? So reminding everyone that the actual note that we create for our private lenders is for a 5-year term. So after 5 years of payments on a property, your loan is paid off in full, and at that time you will sign a certificate of satisfaction to clear your lien against the title.
Amir, why is it that 5 years is the magic number as far as in your experience? Do you feel like, so if somebody was working with a private money lender and they purchase a property and then they sell it on contract for deed, is there some specific reason that you use a 5-year sort of turnaround on that?
Yeah, and so that's where I can share with you what our goal is as a company. Why are we doing this? Because if you do the math, you'll figure out that in this transaction where we are the deed holder on a property like this, and we are doing all the work, we are not really making a lot of money, right? And so our goal as a company is to have free and clear portfolio after 5 years. So that 5-year number, in terms of how the math works out based on what we can charge in the mortgage payment from our end buyer on a land contract, that 5-year works out just about right. And so obviously my goal is to pay off all of these loans in 5 years. So I have this portfolio of mine that is completely paid off.
So if somebody is employing the same strategy for themselves, but they were looking, let's say, more for immediate cash flow, then they could say, work with a private money lender on a 30-year AM, which would be more traditional in order to have more cash flow at the outset if they didn't necessarily want to pay things off right away. Is that sort of the idea?
Yes. So there's many ways on how you can do this. Now, I can also tell you that on our portal, this is our core product, which is a 5-year term product. We've just added another product where we are also doing flips, where the terms are 6 months. Obviously, that's a completely different product. That's why I'm not going to talk about it now, because it's not a contract for deed. But we do have other products as well. Okay, and question, who collects the mortgage payments and deal with the tenants? So we do all of that. Our private lenders do not do anything but collect their monthly interest payments and principal. Question, what should I expect my first loan payment after, when should I expect my first loan payment after closing? So the answer is, depending on the closing date, we strive to ensure that you receive your first loan payment within 30 days from the closing date. Question, do you already have clients with self-directed IRA doing this system with you? Answer is yes. And last question, I have other question, and yes, that's something that we can address when we do one-on-one. And I think that, oh yeah, there's one other thing that I need to talk about is, so in our system, we are a small operation. I run the company by myself, and all the outside boots on the ground that we call them, and attorneys, everything is outsourced. And so that's why we run this operation very lean. And because of that, we do have a little limitation. And the limitation is that we have to control the deal flow with the funds that are available that we can deploy. So because of that, we do not put too many private lenders in our system. And from time to time, we accept private lenders. And at this time, we can only do 5. And if we do accept more, then they're going to be on our wait list. And then finally, this is our contact information. If you're interested, again, there's no commitment, just, just talking and figuring out if you're a good match. You can scan the QR code on the left and you can set up a one-on-one appointment with me. The QR code on the right is for Advanta IRA. And that's all I have, Larissa. And if you have questions, we can answer those.
Okay, great. Thanks, Amir. I just want to remind everybody that this is for educational purposes. So Amir shared his strategy and structures that he utilizes, and the goal here was to educate you on different structures and strategies you can utilize as well. We did answer some questions as we went, but we do have, and just make sure that you're typing any questions into the question box. We have just a few minutes to go over questions. One question that popped up, what is the average default rate? Maybe not necessarily just for the investors that you work with, but over the course of your experience for contracts for deeds, what would you typically say is average on the default rate for those?
So yeah, it varies so much. It's very, very hard. And so because the way we market and put tenant buyers, we have to be very careful as far as federal laws are concerned about, who are we accepting, who are we not accepting. So we just make it very straightforward and transparent. The first person who can come up with the down payment, we actually literally let them in. Now, what that means is, yes, we are taking a lot more chances on default, but then what's happening is, that's our personal philosophy. Honestly, we are dealing with people who traditionally cannot buy homes. There are people who cannot come up with $20,000, $30,000 for down payment. These are the people who work, they make money, but for some reasons the banks don't like them, right? So we have to be very clear on what our goal is. So our goal is to give them the opportunity to buy a home, right? And so one way we let them do it, come up with a down payment as little as $3,500 down, and do a land contract. So that's what our goal is. If that's what our goal is, then yes, we have to have a very easy way for people to be able to get into these homes. Now, I can share with you very simply, we in our industry, we call them lifers, somebody who will now stay in that home for 30 years. So our goal doing this strategy is to, every time when we find someone, obviously from our side, we do our due diligence as much as we can. We do verify their employment so we can have an idea of how much they make. But we found over, because I've told you, I have over 20 years of experience, and I've done, all classes of real estate. Even with all those background checks, and you still have defaults, right? So there's really no guaranteed way of saying that, well, would the default rate be too high? So there's no way. So I can tell you, in our portfolio, we've had people, they came in, they bought the home, and they've not missed a single payment. And we've had people where we had to evict them, and we had people who become late, but then they catch up. And so that's part of the business, but that's something we do. That's why we have our team on the ground, and we take care of all of that, because we can repeat the process very quickly. So unfortunately, I don't have one number to give you, because it's very hard, because it really varies.
Okay, yeah, that makes sense. It probably also depends on the state, the area, a lot of different things too. So, and I would say that real estate investors in general could probably agree. It's just going to depend. And then, outside just the typical default rate, you have, reasons that people might default. And so you're going to see that with, fluctuations in the market and things like that, I would think as well. The other question we had pop up is, do you often see tenants damage the property that exceed the down payment?
Very, very rarely. It does happen. I mean, we employ all sorts of measures to avoid that. So I'm sure some of you who are on the call know cash for keys. If that's the last thing we have to do, we're not talking about a lot of money. But what, some of these people, if they can't pay, the only reason they cannot move out is they don't even have enough money to move to somewhere else. So it's a matter of just finding the problem and solving it for them, to giving them a couple of $100 so they can just leave the house clean. And if they do that for us, remember, we are not doing any repairs. We just turn around, we market it again, and then we have them filled sometimes within hours. So our marketing is very, very, like I said, we use a lot of people in our marketing group, and they are marketing these homes, and there are a lot of people looking for homes. And so it's not very hard to have a home vacant for very long.
Do you feel like because you're basically offering it in not so many words, like seller financing, that that is part of the reason that they fill pretty quickly in your
That's
experience?
correct. That's correct. The idea is really simple, just like how cars are sold. The the person selling the car would tell you about the price, but that's not really the discussion. The discussion is really the down payment and the monthly payment, and the decision is made, right? And so we're trying to do the same thing to make it easy for people to get into homes. Obviously, because we're seller financing, there's cost involved. There's, we have to employ people, we have to pay people to help us do all of this process. That's built into the seller financing. But yeah, it's the idea is the reason why people are so anxious to get in. Number one, just imagine, also understand this, and I'm sure everybody will understand. The people who are moving into our home, let's take a homeowner. If they're moving into a 3-bedroom, 1 bath, I'm just going to pull out a number, and they're already paying $800 or $850 a month in an apartment or even in a home somewhere already, right? So they're already paying that amount. So in their mind, they're like, look, we started with 600, now you're paying 800, and God knows what's going to happen next month. Here we are saying, look, you can lock in your $800 payment for 30 years with only $3,000 down payment. So if you look at it in that sense, for them, it is still a good deal because it gives them the opportunity to own a home. Plus, they don't have to worry about their payments going up every year. Even though we, in our land contract, we do mention that based on the taxes, if they increase, their rate could adjust based on that portion of their payment, which obviously, any homeowner knows that their payments increase when the escrow increases.
Got it. What about, can you sell a land contract?
Yes, it can be done, but that's not what we do. Like I said, in this case, we have a very specific goal. Our goal is to have, for my company, have a free and clear portfolio of properties in 5 years on an average, right? So we have private lenders who started a loan with us a year ago, private lenders who are starting them now. So every 5 years we have paid off loans. Now, so at some point we might sell those properties, but no, we don't.
Hmm.
There is
So,
a market. There is a
yep.
market. You're right. There is a note buying market. That's a very big note buying market out there. Who will buy notes? They do have to see how the track record is for the payer, and based on the value of the home, you can actually sell those. So if you were to do this by yourself, you can sell the notes. Absolutely.
Okay. If somebody asks about the risks, and so I'm gonna kind of just fill you in a little bit on when you are a private money lender. There could be risks. Something to look for, of course, would be loan to value. When you're lending money, you want to look at the value of the property. You also want to do due diligence diligence on your borrower and decide what you're comfortable with. Of course, if you're doing something where you're lending closer to the value of the property, you're going to be at greater risk if there's, some fluctuation in the real estate market and the property value drops. Then of course, if you're in first position, you do have first lien and you could foreclose and take the property back as a private lender. However, you could be, so to speak, upside down in the loan if you're lending too close to the property value. Now, I am not an attorney or an advisor, but these are the risks that you would see out there, and so making sure, again, to always do your own due diligence and decide what you're comfortable with. I host a meeting where we talk about exchanging investments, including notes and things like that. And I always like to say, make sure you feel comfortable with the deal and the person you're dealing with. And so you can somewhat mitigate your risks by making sure that you're doing your due diligence. And again, bringing in a professional team like an attorney, an advisor, or an accountant to help you mitigate those risks. I think that's always very important. Let's see, I think we had that question answered. What helps you to decide what areas you're going to invest in? Like, what are you looking for when you're making those investments so that our investors can kind of understand what your process is? Are you looking for areas where, for example, it's in a specific type of school zone? Is it you're looking for, areas where there's factories for employment or distribution centers? Or what is it that brings you to the areas that you invest in?
That's an excellent question. I'll try to, since this is an educational workshop, I'll tell you what we look for. And if some of the attendees on this call are themselves real estate investors, they'll hear and they'll think that this is against what the traditional real estate investment strategy is, which I did for many, many, many years. Real estate investors are always told to never, ever invest in areas with declining values. Well, guess what? This strategy is exactly what it does. We invest in areas that generally are declining in values. Because if they were not, let me just explain why. So if they were not declining in value, then what happens in all areas when there is appreciation in a market? Flippers, that's where the flippers go in. They look at an older home, they say, oh great, there's great opportunity here, we can go in, buy this for cash, we can put in X amount of money, and very easily we can sell it for this much because there's enough spread there. Well, in these markets, they're not drastically declining, but over a decade or two, they've been declining over a period of time. So what's happening is you don't have flippers going in because there's not enough spread in there. Regular landlords are not very keen in these areas because they just cannot, the properties are declining in value and they cannot justify repairing the properties because the values are not there anymore. So what's happening is gradually the neighborhoods are declining. So I feel that's why we're doing this strategy. We actually revive these neighborhoods. So instead of you seeing boarded homes, we have an opportunity for a home that has this opportunity for somebody to come in and make it their home. So we are putting people in that home. So to answer your question in that way, we are going in neighborhoods where ideally as a real estate investor, you probably may not go in because the values are not increasing. Right? Because that's not what our goal is. The value appreciation is not really a driving factor in this strategy. In this strategy, the driving factor is the rental comps. If the rental comps are strong enough, it supports this model. So that's what we look for.
Okay, that makes sense. And do you find that a home that has 2 bedrooms and 1 bathroom, for example, is harder to fill than, say, a 3-2?
Oh yeah, that's the one. So I'm telling you, as an investor over the years, I was always told, 3 bedroom, 2 bath is the bread and butter home. Always folk. I'll tell you what, this Midwest market especially has tons and tons of inventory that was created after World War II, to attract GIs. A lot of them may be single, and so there's a lot of older inventory that's out there that's 2 bedroom, 1 bath, and they sell as fast. We even have 1 bedroom, 1 bath. We don't buy them, but I know investors who do this similar strategy. They buy 1 bedroom, 1 bath, and they sell very fast. So it depends, but no, absolutely not. 2 bedroom, 1 bath. The bigger ones do sell. They are more desirable, but no, we sell tons of 2 bedroom, 1 bath.
Do you see a lot of people looking at the 2 bedroom, 1 bathroom as sort of a strategy to move from like an apartment, for example, to actually home ownership in that case?
Yes, that's also true. It also depends on the household size. If they have, just a couple and one child, or, a single father or single mother, situation that works for them. Sometimes some of these 2 bedroom, 1 bath are medium-sized homes, so they're like over 1,000 square feet. It's just that they were older homes, so while they only have 2 bedroom, they do have enough space for a small family.
Got it. Okay. Okay, well, I think that does it for the questions. I really appreciate you joining us today, Amir. He left information here on the screen on how you can get in touch with him if you have more questions. Remember that this is going to be recorded and you'll receive the recording. I want to thank you, Amir, and we will talk again soon.